Hey everyone, and welcome back. We're about to do a fully transparent, deep dive into the Blueprint to Escape portfolio. We're going to break down how it performed during what was, well, a pretty wild February, talk about the moves we made, and lay out our exact game plan for March.
Okay, before we get into the numbers, we just have to do a quick disclaimer. Please remember this analysis is really for educational and entertainment purposes. It's not meant to be taken as financial, tax, or investment advice.
We always encourage you to do your own research, and you might find it helpful to consult with a licensed professional to get guidance that's really tailored to your own personal situation. And just so we're super clear, none of the companies or ETFs we talk about today are sponsors. They're just part of our own ongoing research. This whole analysis by Blueprint to Escape is completely original and based on our own work. All right, let's jump in. Here's a quick look at what we'll cover. We'll start with the market roller coaster we saw in February. Then we'll walk through the specific moves in our Canadian and US portfolios. After that, we'll get into the philosophy that guides all these decisions. And finally, we'll lay out our game plan for March. So, February was eventful, for sure. We saw some real strength in defensive sectors, but other areas, like tech and blockchain, they definitely felt some heat, and that had a direct impact on our portfolio. Let's break down what that actually looked like. One of the first numbers that might pop out at you is the portfolio's current yield, which is sitting around 15%. Now, that's a big number, but it definitely doesn't tell the whole story. In fact, it's a direct result of what was happening in the market. And this brings up a really important question for anyone who's an income investor. Is a rising yield always a good sign? Sometimes it's actually telling a very different story about an asset's price. It all boils down to this simple inverse relationship. So imagine an ETF pays out a steady $1 per share every year. If that share costs $20, your yield is 5%. But if the market pushes that share price down to, say, $10, but the payout stays the same, your yield automatically jumps to 10%. It's the same amount of cash, just a higher percentage of a lower price. And that's exactly what we saw play out. This 15% yield is basically a symptom of that price drop. It's reflecting a temporary, on-paper loss of about 10%, mostly in our tech, fintech, and blockchain holdings. Now, we haven't sold anything, so those losses aren't locked in. We're just sticking to our dollar-cost averaging strategy, which just means we keep buying at regular intervals to average out our cost over time. And this slide really pinpoints where that pressure was coming from. The main drivers were ETFs like HOHIS and especially HBTE. As you can see, HBTE had a particularly rough 30 days. This was because some of its underlying stocks, like IRAN and HUTE, had a really weak start to the year. So, with that as the backdrop, let's pivot and talk about our Canadian portfolio and get into the specific actions we took in response to all this. Okay, here's a snapshot of our full Canadian holdings, which make up about 80% of our total portfolio. I know, there's a lot of data here, so please feel free to just hit pause on the analysis if you want to take a minute to look over the tickers, the yields, and how much weight each one has. So, our first move this month was adding a new position in HUTE, which is the Harvest Global Utilities ETF. The thinking here was pretty simple. We wanted to add a bit more stability. The Canadian energy sector and global utilities have been doing better than the broader market, so this ETF gave us some nice balanced exposure to that strength. Next up, we added a small position in CANY, the Evolve Enhanced Yield ETF. And this one was actually based on a really great suggestion from one of you in the comments, so thank you for that. It pays out bi-monthly, has a really high yield, and it focuses on strong Canadian financial and energy companies, which again fits right into our strategy of holding these more resilient sectors. We also did a little bit of strategic rebalancing. We decided to trim some of the profits we made from our HMAX position and move that money over into HDIV. At over 16% of the portfolio, HDIV is really the anchor of our Canadian holdings, and it was incredibly stable during all the February craziness, so we felt it was a smart move to beef up our largest and most stable position. And now we have to talk about HBT. Last month, we mentioned our plan was to start reducing this position because it's so volatile. But given that big price drop, selling right now would mean locking in a pretty big loss. So we've adjusted the plan, we're holding it for now, and we're just going to wait for the price to recover before we start trimming it down. We still believe in the long-term story of blockchain and fintech. Okay, let's switch gears and head over to our US holdings. Now, this part of the portfolio makes up about 20% of the total, and this is where we saw some real standout performers on the defensive side, which was a great counterbalance to the tech weakness. Here are all of our US holdings. And again, this is a great place to pause the analysis if you want to take a closer look at the different positions and their weights. You'll see it's a mix of some high-income funds along with a few long-term growth plays, like Google. Now, this slide is where it gets really interesting. Look at that contrast. While the major market indexes were either flat or down, two of our key defensive holdings just absolutely took off. ASGI, which is a global infrastructure fund, and ET, Energy Transfer, a midstream energy company, both delivered amazing returns. This is exactly why we own them, to do well when other parts of the market are struggling. And this chart just paints the perfect picture. You can see the performance of ASGI in blue and ET in orange, both climbing steadily upward. Now compare that to the NASDAQ 100 in purple and the S&P 500 in green. They were just choppy and down over that same 30-day stretch. Our holdings just completely bucked the trend. Feel free to pause here and just let that sink in. You know, seeing how these different pieces of the portfolio worked, with tech pulling back while the defensive side surged, it really highlights why having a clear underlying philosophy is so important. So let's take a minute to talk about the core principles that guide all of our decisions, especially in volatile months like this one. At its heart, our goal is really simple. Build a stream of sustainable passive income that also has room to grow over the long term. But above all else, priority number one is preserving our capital. To do that, we focus mainly on monthly income investments, like covered call ETFs, and we reinvest 100% of that income to get the power of compounding and dollar cost averaging working for us.
How we allocate our assets is just as important. We always aim for a balanced structure, and a hard and fast rule for us is that no single holding ever gets to be more than 15% of the total portfolio. That stops us from being too exposed to any one thing. We also keep a little 5–10% sliver for more opportunistic or fun plays. But maybe the most important rule is to avoid overtrading. We make a plan and we stick to it.
We also try really hard to avoid something people sometimes call worsification. That's when you diversify just for the sake of it. For instance, you might own two different big tech ETFs and feel diversified. But if you look under the hood and they both have Apple, Microsoft, and Google as their top holdings, you're not really spreading your risk. You're just concentrating it. For an income portfolio like this one, we find that 20 to 25 well-chosen holdings is kind of the sweet spot. And finally, so much of this comes down to mindset. We're focused on total return. That's the share price growth plus the income, not just blindly chasing the highest yield. We try to invest with conviction and stay stoic, avoiding those emotional reactions to the market's swings. We really make a point to understand the businesses we're investing in. And of course, your portfolio should always be matched to your age and your own retirement goals. So, with that philosophy as our North Star, let's wrap this up by looking at our specific, actionable game plan for March. We've got 4 main priorities on our radar. First, we're going to keep accumulating shares of Google. That's our core long-term growth holding. Second, we'll keep adding to ILF, which is our ETF for Latin America exposure. Third, we're going to be watching HBTE like a hawk, looking for a price bounce so we can start trimming that position. And finally, going back to that worsification idea, we're going to look for ways to consolidate some of our Canadian ETFs to reduce overlap and just make things a bit more streamlined. If there is one big takeaway from this whole month, it's this. The strategy is working just like it's supposed to. Even with that turbulence in the tech-heavy parts of the portfolio, the overall structure stayed stable, and our defensive plays in energy and infrastructure did exactly what we hoped they would, really proving their worth when things got choppy. And hey, if you found this transparent breakdown helpful, do us a huge favor and hit that like button. It really helps us out. And of course, make sure you subscribe so you don't miss our monthly updates. We'd also love to hear from you, so please drop any questions or even your own favorite income strategies down in the comments below. We put out this full portfolio analysis around the 20th of every single month. And by subscribing, you'll also get our other content where we explore things like financial independence, passive income, early retirement, and what we like to call nomadic life design. So we'll leave you with this final question to think about. What's the anchor of your portfolio? What's that one holding or sector that you really count on to keep things steady when the markets get rough? Let us know in the comments. Thanks so much for joining us, and we'll see you in the next analysis.